Let's see now the main efficiency ratios and how they work. But first of all, let's see what is efficiency, how do we assess it, and what are the main efficiency ratios. First of all, efficiency is the ability of a company to manage its resources so that they will generate a good or a service for a lower cost possible. Eventually, the company is going to be able to sell the product for higher price compared to the cost and therefore generate more profits. Therefore, when a company is efficiently managed, it means that it's using its resources at the maximum, a matter of the capability of the management to use the assets of the company to produce as much as possible, and to a point in which the costs associated with production will be lower compared to the price that then the company is going to charge to the customer. How do we actually assess efficiency? Well, to assess efficiency, we have to look at different items on our balance sheet and income statement and how those are intertwined. But first of all, for example, the efficiency is a relationship between either the inventory and the cost of goods sold, or actually the accounts receivable and the sales, but also the accounts payable and the COGS as well. But actually, let me show you here two main efficiency ratios that are used in financial accounting. And the reason why I'm just showing those two efficiency ratios, the inventory turnover and the accounts receivable in days, because those are ratios that you can use as an external person, someone who is not internal to the company. Therefore, if we look at our inventory turnover first, this is given by the relationship between COGS and average inventory. So if we go on and we solve this example here, we can get our cost of goods sold from our income statement. And then we can do the same, we can get our average inventory. Our average inventory is given by the inventory at the beginning of the period, and for such we mean the inventory in the previous year divided actually the inventory in the previous year plus the inventory in the current year divided by 2. And that's how we actually get our average inventory. And as you can see here, we have 1.82. It means that we're actually able to convert our inventories in cash 1.82 times in the year, and that's a good result, as you can imagine, because it means that we don't have any inventory left. And as you can imagine, when the inventory turnover increases over time, this is a good sign, because it means that management was able to acquire and to purchase the inventories and to convert them in cash. There are not additional costs associated with keeping more inventories into the company. If we move forward now and we look at the accounts receivable in days, I want to show you what this metric is for. And this is a very interesting one. Why? Well, because if we take our average account receivable that is given by the account receivable in the previous year that we have here, plus the account receivable in the current year, and then we divide them by 2, that's how we get our average accounts receivable. But then we want to get our sales divided by 365, the days of the year. And once we do so we get our sales, divide them by 365, we get a result here that is 10.43 days. What does this actually number mean? Well, this number means that we are able to convert our accounts receivable into cash every 10 days, 10.40 days. So let's say from 10 to 11 days. And this is a very good result. This is a great result. It means that when you're able to convert your accounts receivable in cash, it can be very good for several reasons. First of all, for example, it means that your collection department is actually doing a great job in collecting the money from the customers, or it can be that just you have customers that pay as soon as they buy the good that you sell them, and that's very good because it doesn't happen often. Also, sometimes when we see an increasing accounts receivable in days, it means that, for example, we changed our policy if we allow, for example, customers to pay instead of 60 days in 30 days, as you can imagine, this is going to increase the collection period and therefore is going to give more liquidity to the company. Therefore, as you can imagine, when we have an accounts receivable in days that increases over time, this is definitely a good sign. Although, again, when you use the ratios, you have to be careful as well, because we might miss some information that instead internal people or people that work from inside have and that we do not actually have. That's why you want to be careful, and also when you run this kind of analysis, you want to cross these ratios with other ratios.